Welcome, Farewell fans. Welcome to another episode. Welcome to another interview. And today, I have one for you. Now, I know everybody is always concerned about investments. They're always concerned about how their money is. They're concerned about a lot of things. So, I talked about investments. I talked about how you should invest for your kids, invest for the future. We've had those conversations. So today, I have Frank here, and he has the Golden Playbook of investments. He has the Golden Playbook. Frank, how are you doing today?
Good. Thank you for having me on, MNG. Appreciate it. Thank you so much.
Hey, not a problem. Thank you for coming on to the show. So, Frank, before we go ahead and get started, can you just tell the audience, the Farewell fans, just a little bit about yourself?
Sure, by all means. I spent 40 years as a financial advisor, and bluntly, you learn a lot about investing when you work as a financial advisor. You watch your clients deal with their money. Some make some great decisions, some make some bad decisions, and you explain things 1 million times. And you get pretty good at explaining things, and you get pretty good at explaining the complexities of investing. And my clients always told me I was able to explain the complexities of investing quite simply, and they understood it, and they appreciated that. So I figured, you know what? Hey, why not produce a book? So there it is.
So now let me ask you, now what got you started to be a financial investor? And the reason why I asked is because I was offered to be a financial investor, and I thought it would have been a unique opportunity not only to learn about investments, but also to be able to teach it to other people as I was progressing through the career. And as good as it sounds, it was transitioning from one position to another position. But how did you get started into it?
I got started. One of my friends was in the securities business, and I saw he was doing quite well, and I thought, well, I could do that, So I got started, and I went to work as a financial advisor for a company by the name of Smith Barney back in the day, and I started in 1982, and ultimately I moved to a company by the name of Security Pacific, both which companies have been absorbed by other companies by now. Then, of course, we transitioned to Bank of America. And then I transitioned to Merrill Lynch, which when B of A bought Merrill Lynch in the fall of 2008 and 9. So I've had, in effect, two employers, but one, of course, and my name changed two more times after I got there. But the bottom line is that I was always interested in investments and making money. And, I thought, you know what? It's a great career, and why not give it a stab? So I gave it a shot, and quite bluntly, it worked out really well.
Okay. So in your opinion, what would be the best time to start investing?
Today. Sounds sarcastic, but you know what? Everybody that waited, I saw people wait. They go, I don't know about investing today. I don't know, blah, blah, blah. Bottom line is that I never saw where it paid off. So you don't necessarily have to take, if you got a X number of dollars, you don't have to dump it all at once, but you can kind of filter into the marketplace, if you will, or market, and let it grow. But again, I think that you don't want to necessarily wait forever and ever and ever, because generally I think that the market is on a trajectory that's upward, and you're going to miss out on those upward movements, if you will.
Okay. So, and I want to make sure that the Farewell fans get a great understanding about investments, because some may know about investments, some may not know about investments. For some people, it's a foreign language. I've talked to some people that say, "Well, I know nothing about investments." And there's plenty of YouTube videos and books on investments, but they'll be like, "Well, I don't know anything about it." So when Frank is saying that today is the time to invest, the sooner you invest, the better. If you're 21, you should start investing. If you're 18, you should start investing. If you have money that you're spending off somewhere else, maybe you're spending it on clothes and stuff like that, and you have millions of clothes in your closet already. Take that additional money, put it in an investment. It's probably one of the smarter things you're going to do with your money, because it's going to grow exponentially over time as long as you keep investing that money. Okay, and not to go in too deep into breaking it down and everything, but Frank, so now what compelled you to write this book per se? Like, most people after retiring, they kind of just slow down. They kind of just chill out and enjoy the breeze and go watch the palm trees. But you're like, you know what? I still want to educate some people. and kind of get them in the mindset of investing?
Right, exactly. That's a very good question. And when I retired at the end of 2021, I thought, why not? You know what? Let's give this a shot. The bottom line is the fact that I felt there's a gross lack of knowledge about investing in America, and that it's not really taught very much in schools. And we had some 401k accounts we managed, and a lot of people were putting their money in the money market account. And the money markets, when I retired, they were paying literally 1/10 of 1%. So
Yeah.
you're never going to grow your money, but at 1/10 of 1%, believe you me. So I felt there was a gross lack of knowledge, understanding, and there's also, when you retire, you want a sense of purpose because you're on
Mm.
this fast track as an investment advisor, and and you're getting up every morning and hitting the road, and going after clients and talking to them and so on and so forth. Well, also that comes to grinding halt. So why not substitute all that nonsense, if you will, to writing a book? And it took me 3 years to write the book, but which is way harder than I thought it was going to be. But bottom line is that the satisfaction level I've derived from writing that book has been huge. So it was worth it, absolutely. Highly recommend doing it.
Okay. So now let me ask you this. Now, if a person was just starting out a portfolio, what would be a recommended? No, now we don't have to talk about companies or anything, but the standard ETFs and mutual funds and everything. What would be a go to start off with? Say if you're a person that is risk averse, so you don't like taking a lot of risk, but you want to kind of play it safe, but you still want to maximize the amount of money that you're putting in there.
Absolutely. So basically, it's a fairly simple. It's a complex question, but I have a fairly simple answer, and that, of
Okay.
course, is that if you buy the exchange traded fund, an exchange traded fund, of course, is a bushel basket full of stocks. If you buy the ticker symbol SPY, SPY, just like it sounds, that mirrors the performance of the Standard & Poor's Index 500. So basically what you're doing when you buy that, you are buying, in effect, 500 different corporations across America. And the
Mm-hmm.
bottom line is that the return on that particular portfolio over the years has been around 10% per year. For every
Mm.
4 years, you'll have 3 years that are winners, and 1 year is going to be a loser. Now, that's history. And of course, there's no guarantee history will repeat itself, but the bottom line is I tend to think it will. And, most years you're going to get more than 10% per year. But the beauty is you can buy this, and if you do it through a discount broker, for example, like a Charles Schwab or Merrill One or what have you, there's no
Yeah.
fees to buy that. You reinvest the dividends, again, no fees. And the beauty is that you can buy fractional shares, so you can actually, kind of chug along at your own pace. But if you go back in time, and you did this 35 years ago, you start with $5,000 and do $300 a month, which is $10 a day, you'd have well over $1 million in 35 years. And again, if you can add just a little bit more to that, more than that, you could come up with quite a nice sum of money. And again, I tend to believe history will repeat itself.
Okay. So now now I have two questions for you. So the first question is that what no, I have one question, but I want to kind of break some things down for the farewell fans. So the portfolio that he was talking about is what most people know it as an ETF, which
Correct.
allows you to buy a lot of companies at one price. So you now investing in multiple companies, and they have this for different industries. Now also going to a brokerage account. So yeah, you can go through Charles Schwab, Merrill Lynch. You can go through those corporations or the brokerage firms, and they can go ahead and you can go ahead and set your account up. Now they have it two ways where you can have self-driven and you can also have it managed for you. So you
Right.
can do it either way. I would say self-driven just so you can kind of get an idea if you want to take money out of something and put it in something else. You can do all that stuff yourself, depending on how familiar you are with it. Now, what I will also say to that is that you can also invest in individual companies if you want to, but ETFs are definitely a lot safer because if one company is going down, but you got several companies going up, you're not going to see the extreme volatility of the stock market because
That's
you're
correct.
investing
Yep.
in companies. Now, we know that in the last few years that retail investors have kind of flooded the market. So you had mentioned the buying fraction of of a stock. So we know how retail investors have flooded the market. In your opinion, noticing that, what do you think the impact of retail investors have had on the market itself and just investing in general?
Well, I think they've had a fairly significant impact because the more money that floods into the market, the more it drives the prices higher.
It
And
does.
I'm hearing constantly now on the business channels that there and or the Wall Street Journal or what have you, is that there is a lot of quote unquote cash on the sidelines that is not invested. And generally speaking, that is a bullish sign for the stock market. Again, not a guarantee because we have a lot of other stuff going on out there that could be, detrimental. But bottom line is that generally speaking, again, history repeating itself, is that cash on the sidelines generally gets deployed at some point. So I tend to think that's going to be a very positive situation for the market. So, we'll see. But bottom line is that we don't know for sure what's going to happen in the future. But have some courage and get your feet in the water.
I definitely agree. Definitely want to get your feet in the water. And I'm very serious about driving this home. I started an investment account for my son when he turned like 16, and it's a custodial account, and we just put all his money in there. We put his child support money in there. We put whatever his allowance was. We made sure that we kind of broke it down and put money in there. We always did 15% of what we brought in to go ahead and put it to that account so he can go ahead and set it up.
Sure.
Now, Frank, let's talk a little bit about your book, The Golden Playbook. Okay. So we know why you have wrote it. So can you give us a little bit more insight about the book in itself?
Sure, absolutely. So what I tried to do, of course, is make it a little more interesting because a lot of investment books are kind of like a medical dictionary or medical book for doctors. And of course, the subject would be digestive disorders. So I tried to make sure that we didn't go down that road because nobody wants to read about that subject. So I try to include a lot of clients in my book about real life experiences. I even have some pictures of a couple of clients in the book. And bottom line is that we made it, as my editor and myself, we made it very interesting. It's a very easy read, simplistic concepts. And we have 12 golden rules that I like to tout in the book, of course. But again, it's not a typical college textbook in any shape or manner. Because college textbooks in general about investing are tough read. It's tough read.
Yeah. Yes. Yeah. I remember we did finances in school and talked about investments, and it was something else. Very interesting. Very interesting time. But so when we're talking about your book, what is one thing that you believe every person should be able to take to heart from his book, regardless of income?
Well, I do include some other subjects in the book besides investing because my goal, of course, was to try to give the reader every potential bit of knowledge that I'd garnered over the years. So I even include, an epilogue, which I entitled "Gratitude is Golden," because I firmly believe that being grateful is a very strong way to ultimately succeed. It's one of those secrets of life. Another one I even talk about, of course, is charitable giving, because again, one of those secrets of life is that if you can have enough prosperity in your own investment accounts to give money away, which is where I'm at right now. Again, that's very, very powerful. And I think it's also good for your health of all things. So, again, these are two concepts I incorporated in the book. And again, you will never find those two concepts probably in any investment book you ever read. But that's part of my goal is to give the client every tool for success that I know of.
Okay, that's understandable. Now, in the book, what are some of the stories in the book that you have written in there that the audience will find appeal to?
Well, my first chapter, of course, I talk about a former client by the name of Leo Arena. And Leo Arena is quite the affable man. He acquired his first shares of Bank of America stock, believe it or not, from APG&E, who was the founder of Bank of America. And he acquired those when he lived in San Jose when he was working as a dentist. The beauty of it, of course, is the fact that he told me over and over again that he never made any money by being a dentist. He made it all by investing in the stock market. And when he passed away, now almost 25 years ago, his account was worth $50 million. That's quite a tribute to a person that ever made any money being a dentist, but he made all his money in the stock market. And he'd always say, when the market was down, he'd call me up and say, "Get those amateurs out of the way, I'm coming in." And that's what he would do. He'd come in and buy more stock. And he very rarely sold. He only bought quality companies that had a track record. And he was quite the inspiration because he was extremely affable. He looked 20 years younger than he actually was, and he died almost at the age of 103.
Oh, wow.
Yeah. Oh, wow, I was right. Oh, wow, I was right. Yeah, no question. No question.
Man, so just
inspiration, let me tell you.
Definitely. So to be able to invest in the stock market and reinvest, and over the course of 25 years, the man had $50 million.
Yeah. And of course, he started probably back in his 30s or 40s. But having said that, he probably didn't start with very much money either, because
True.
I mean, let's face it, back in the 30s and 40s, you weren't making a lot of money, period. So he was, not available to invest that much money, but yet he still did extremely well.
And when you mention quality companies, what was the one thing that he was looking for in order to establish whether a company had a strong foundation in order to invest in?
Well, I think one thing he looked for, of course, is one that has a good solid track record. In other words, if the company's been around for a number of years, and the stock price has grown over the years, and all of a sudden takes a big dip, that to me is a buying opportunity. You'd also look for companies that pay a dividend, because dividends are important, but that wasn't his major goal. That was just simply indicative of a company being of quality orientation. And I'll never forget one time when Bank of America increased their dividends, and he was literally now making over $300,000 more per year on his dividends. He was not happy because he wanted to see Bank of America plow the dividend money back into growing the company by virtue of either advertising or taking on more enterprises or doing more lending or what have you. So he was all about the growth on the company stock. And of course, he was able to pick out those companies that did really, really well. And of course, the proof was in the pudding, as they say.
So, Pharaoh fans, just to kind of give you an understanding of dividends and everything. So, dividends is earning that is paid back to the investor. So,
Correct.
If you invest in the company and you buy so many shares, then you'll get dividends of a percentage of the dividends that is associated with how many shares that you currently own.
Correct. Yes, normally dollar or cents per share, if you will.
Yeah. So you'll get so much money back. Now, people hold different companies that produces different dividends, and every company doesn't produce dividends, and every company doesn't produce dividends. Like some do it quarterly, some do it yearly, some do it every 6 months. But they don't do it as often. So some people would hold a portfolio of companies that pay out dividends. Now you could do two things with those dividends. One, you can have them reinvest, as Frank said, you can have them reinvest back into the company, which essentially buys you more shares. And then there's the other way, which is you could just take it and I don't know the IRS portion of it. I'm not too sure. I don't know if it's going to be counted as income or anything.
Yeah, it's counted as income. And most corporations in America pay what they call qualified dividends, which is taxed at a much lower rate. That's taxed at approximately 23%, versus the maximum rate of 37%. But the reason they pay the dividends, of course, is to attract more investors. So
yes.
But most of your technology companies, obviously, the NVIDIAs of the world and so on, do not pay dividends. So
no.
Yeah. But technology companies, of course, have been doing much better than your dividend-paying stocks as of late.
That is true. And the only thing I can suspect is why they don't pay dividends, because they're consistently innovating, growing, and they'll need all that capital in order to be able to expand, whether they're buying other companies or looking for different deposits or whatever, or research and development. So that's
absolutely no question. No question.
Because you can't create groundbreaking technology and give money away at the same time.
Amen. Amen.
It's just not going to work. Okay, so yes, Pharaoh fans. So if you are looking to invest and to create a secondary income that come in through dividends, you will have to invest a large amount. You can't just go in and invest $10 and think that you're going to get $5 in dividends back. That's
Yeah,
not
that's
how
true.
it's going to work. But you're going to have to hold a substantial amount of shares in order for the dividends to actually mean something. Okay. So I just wanted to make sure that I broke that down for y'all, so y'all can, so it's not too much foreign language that's being spoken. Y'all just like, well, what is that? What is that? What is that? No, I got
Right,
y'all. Don't worry.
right.
We talked about this, but I got y'all. I got y'all. All right.
Yep, yep.
So I want to so the book talks about, attributes of the affluent. And I know you had talked a little bit about that. Can you just share a few that an average person can adopt there to shift their mindset around money?
Sure, absolutely. Appreciate that. No worries. Bottom line, of course, one of the first ones, of course, is visionary. Um, I found that the affluent typically can somehow look into that crystal ball and take action that ultimately rewards their action many times over, if you will. So a perfect example, of course, would be, shall we say, Jeff Bezos, who started Amazon, started as a book company, and of course was able to somehow take that concept of buying items on the internet and expand it to the point where you can almost buy anything today and you want on the internet. Pretty much everything, not quite, pretty much. But
Yeah.
visionary, of course, is certainly one of those strong attributes. Another attribute, of course, is good old-fashioned courage. If you
Yeah.
have courage and you got, the courage to take a little bit of risk, that is huge when it comes to investing because you're going to have days when you're thinking to yourself, what in the hell am I doing? And I remember in 2008-9 when, shall we say, the proverbial stuff was hitting the fan, it took courage to hang in there. And of course, I was worried and I was losing sleep, most nights. But I personally never sold and I kept investing. Best thing I ever did. And then, of course, the last one of the other attributes, of course, is that there's one of generosity. I talked about this briefly earlier. But again, I don't think you're ever prosperous until you get to the point where you can actually help others by giving money away or giving your time to help other people. So those are three attributes of the affluent that I found over the years. And it's something we can all try to emulate, if you will. And I would highly encourage people to think about that and go for it.
Okay. So that's an interesting take. Just be able to change your mindset. I'm just trying to think of a way to just put it in words, a little bit, and I lost it. I lost it just that quick. Okay, so now I also want to circle back around to gratitude is golden, and I know we talked a little bit about gratitude, but I kind of want to go a little bit deeper into it because I know a lot of people, they understand gratitude and some people give gratitude. But when you talk about gratitude and you talk about investing, talk about giving away money, donating, however the case is, I know for some, it could be, yes, I can write that off as a charitable donation. I can do this with it. I can do that with it. But, you're saying that, gratitude is golden is because, when you're investing, you're giving away money, it actually becomes a benefit as a rule of, I want to say like this like karma. What you put out is what you get back.
Yeah, no question, no question. Again, I think it's certainly a strong secret. Um, I just firmly believe that you really, if you can count your blessings and be aware of all the good things that you have, that of course is huge, and I think it does tend to multiply your success and all the things you're grateful for. Um, if I look back on my own life, if I look back to when I was first married 45 years ago, and see where we are today, I would think to myself, gee, what did I do? Win the lottery? Well, I didn't win the lottery, but I won a better lottery, and that, of course, is the lottery of life. So
Yeah,
I think that this concept that I utilized each and every day about being grateful, I think multiplied my riches, and I'm not just talking about money, but riches in general with people and with all my parts of my life. It multiplied everything exponentially. And so I really try to drive that point home because again, if you feel good about where you are in your life, that to me is certainly like winning the lottery. But again, winning the lottery of life, not the thing you go to 7-Eleven to buy a lottery ticket for.
I agree because I also believe that you got to have some level of gratitude and appreciation for the things that you have, and build upon that. And as you build upon that, and you show that grace, you show that um, that understanding of the things that you have can also be taken. Then you show more appreciation for the things that you have. You kind of operate more a little bit more cautiously and strategically, I would say.
Yep, no question.
Now you work with one-on-one clients, and now you are reaching the masses. What has been the most surprising and touching feedback you received since publishing your book?
I would say there's two concepts there that I think have been fairly unanimous on both fronts, if you will. And one of them, of course, is that most people tell me, "I wish I'd had your book earlier, in
Mm,
my life." I've heard that repeatedly over and over and over and over again. And the other day I was on a podcast, and the lady I was on the podcast with told me that her husband bought the book, and his comment was, "It's an easy read, and I understand it. It's very simple, and I can understand all the various concepts." So that's the other comment I've heard over and over again, is the fact that it's not that complicated. If you go to a financial advisor and they start talking about standard deviation, and yield to maturity, and current yield, and dividend yield, and all the various vernacular about investing,
yeah.
pull back a little bit, Mr. Advisor, and have some patience and talk to people in terms they understand. So I do cover some subjects in the book about regarding these things, so a person has some expertise, but yet I do it in such a way that it's interesting and it's not complicated.
Okay. So, and by writing this book in the most simplest terms, I do believe that and I read a little bit of the book, and I was like, man, this is some of the same things that I was reading in high school. I'm reading now in some of the simpler terms. And then back in high school, we had to go through the newspaper and actually do the calculation ourselves for the dividend stock. And then you had the fractions and everything. Like it was crazy. But yes, it is easy to read, to put into simpler terms. And from when I was reading, I read the first chapter. From when I was reading, I was like, man, I was like, this is really good, because I had financial advisors before, and at the time when I was asking about investing, as you had stated earlier, it was like, well, you're gonna need about you're gonna need about $10,000 just to start your portfolio. And I was like, man, I'm like, wow, like $10,000 just to start the portfolio. And this was only 2013, like between 2013 and 2015. And you need 10,000 to go ahead and start a portfolio. And I was like, well, I can't just start off with like 1,000 or anything. They're like, well, to actually build a adequate portfolio, you needed $10,000 at the time. And which goes back to retail investors, because now we have the retail investors, and you can buy at a fraction. You don't have to buy the whole share at $200. You can buy $50 of the $200 share and start building your way up to that one share. So when I think about this book and think about what you're doing, it takes me back to the time where I was familiar with the concepts. And when I went to talk to financial advisors and was trying to get into investing, because getting into investing wasn't as easy as just downloading the app and uploading $5 as it is now, it makes you appreciate it more, because now you can download that app and go ahead and upload that $5 and learn how to invest. And now you have so many more people out there learning to invest and teaching to invest. And this book right here is probably one of the more essential tools to have and read, to be able to understand investing, knowing and looking at the inspirational stories that are there and the strategies and everything, to be more aware and familiar of what you're getting yourself into, without having to go through a whole class, without having to sit down and have to go through 5 or 10 different YouTube videos trying to figure out, well, where do I start? How do I put it all, and how do I piece it all together?
Yeah, thank you. I appreciate the endorsement. You said it very, very aptly. Thank you. You know,
You're welcome.
bottom line is that I would hope to God I could help millions of people across America. Because guess what? When I read the statistic that half of people in America retire with no money saved for retirement, I thought to
Yeah.
myself, what the hell? I mean,
Yeah.
people, my God, people, remember the days go by slow and the years go by fast. And guess what? All of a sudden you turn around and all of a sudden it's time to retire. In my case, it sounds like I'm bragging, but it's the truth. I mean, I started my 401k when I was 35 years old because we didn't have a 401k when I first started my career way back when, right? So
Right.
I somehow managed to contribute as much as I could to that 401k every year. And when I retired and did my IRA rollover, I looked at my IRA and I go, oh God, I've got $8.5 million. So and today we're about 9 million. I've taken about $300,000 out so far this year because of minimum required distributions. But I mean, you know, we have in our household, my wife and I have no money worries. Thank goodness. And of course, even with a book here, because we have a house full of stuff, if you will, we're not going to, if we make $1 million in the book, we'd give $1 million to charities. So the goal, of course, is to, again, give back, and we don't need more stuff. Believe me, we're very blessed, extremely blessed. And it's a lot of times because I did the right things along the way. And candidly, sometimes the concept of maximizing out my 401k every year, I'm not sure I even thought about where I was going to wind up with the money at that point. I just figured it was a good idea to save as much as I possibly could. So I'm blessed from that standpoint because now I would for sure would know exactly what I'm doing, max it out and do the same thing again. But I would do exactly the same thing every dollar I went into the stock market. So, when you're 35 years old, you got long runway. Guess what? All in the stock market. So that proved very, very profitable.
Yeah. Yeah. I agree. And that's massive. Like I ain't nowhere near that.
Well, you're not my age either. You want to switch ages?
I'm far away from that total. But I will say that in these times, farewell fans, that do not fret. Whatever happens in any situation, do not pull from your 401k. I know a lot of people have done it. I have done it myself. I've done it myself. I've done it to buy my house. I've done it when I get laid off. It once you leave, it becomes accessible. Once you leave a job, it becomes accessible and becomes very tempting to go and withdraw on some of that money. Now, unless you plan on doing something real spectacular with it, like taking it out and then throwing it into the stock market on your own accord, then, maybe. But keep in mind not to go ahead and touch it and just try to figure out other ways to kind of manage and keep that money. No, so it's not an emergency fund. Don't think of it as an emergency fund.
No, it's not an emergency fund. No way. No way.
If I get fired, I got this money over here that I can go ahead and use. That's not what it is.
No,
Because
no.
if we're looking at the economy and how it's moving today, for my age group, Social Security is not looking very promising. So, we definitely want to be able to have money saved up that is going to last us at least until, I'm not saying you need to have enough to pass on to your grandchildren or your children, but you want to have
Right.
enough so you can survive at least a good 10, 20 years without worrying on, what when the next check is going to come and everything. So you want to kind of keep that in mind because I know it's very tempting for everybody to just, oh, I could just dip to my 401k because it became very accessible during the pandemic. So I believe that everybody has in his mindset that if I have money in my 401k, yes, I could just go in, dip some out. Yeah, I got to pay it back at the end of the year, but it's 10% on the front end, 10% on the back end. I'll figure it out somewhere down the line. So I kind of want the farewell fans to kind of be in the mindset of not thinking about taking out that money from 401k when you get on hard times. I know you can take loans out, and that's all well and good, but understand what happens when you take out loans for 401k is that you have to pay that money back and you pay it back over the duration of the checks that you have. So you're solving one problem, but you're not creating another problem because now you're shortening your checks for a length of time, and these are automatic deductions to pay the money that you took back. So now you're paying double into your 401k account. So a lot of people don't think about that when they go and they take this loan. They're just like, oh, I can get this immediate money, and then I can worry about it on the back end. But when you're paying that money back, you're actually paying it back twice. You're paying what you're regularly paying, and you're paying this loan amount that you took out to pay back. And yeah, it's cool to think, yeah, I'm paying myself, but you're reducing the money in your check. So whatever
That's
money
correct.
that you had to play with, now you have less to play with, and you're trying to figure that out for how many ever weeks. If you get paid 52 times out of the year, it's going to be divided over 52 checks. If you get paid
Yep.
26 checks, it's going to be divided over those 26 checks. So you have to be mindful and strategic on how you're going to play that game when you're talking about pulling that money out to pay something off, but then you got to turn around and pay it back.
That's correct. No question. No question. And of course, the bottom line is if you take the money out of the 401k, it's no longer invested anymore either, because
That's
now
right.
it's, you're spending on something else. So you're also losing, of course, the potential and growth of that money when you take the money out. So it's a slippery slope. And for me personally, I never took money out. And thank goodness, because it really grew nicely over time.
Yeah. So in a time when people feel overwhelmed about money, and it's kind of brings it full circle to what I was just talking about. In a time when people are feeling overwhelmed by money, what advice would you give to someone just starting out to control their financial future?
So again, I think the bottom line, of course, is that you need to understand that the sooner you get the mental mindset, which I cover in chapter 1 of the book, you have to have a prosperity mindset. That, of course, means that you're now saving and investing. And it's the sooner you start that, the earlier in your life you are, the more that money has a chance to grow and compound and give you the nice big nest egg when you ultimately retire. Because remember, I didn't start investing in my 401k till I was 35. And of course, nowadays, since the 401ks are available in a lot of most companies you work for, if you're 23 years old, if you can possibly, even contribute $3,000 a year, you're going to be way ahead, down the road a ways. So again, it's all about having the discipline to start sooner rather than later. Have the discipline to let that money grow and stay in that 401k and earn you a nice retirement when you ultimately retire.
Yep, I agree. Now, let me throw this in there. Now, we talked about overwhelmed about money, but there are some people that, because overwhelmed about money can be applicable to a lot of different things, right? So if somebody was trying to pay off a high credit card debt, they make good money or they make okay money, but they have high credit card bills, what would be the process to be able to get those down so they be able to start investing?
Well, I think the bottom line, of course, is if you're paying, high credit card debt, generally speaking, you want to pay that off sooner rather than later, primarily because typically the interest rate you're paying on that credit card debt is going to be probably north of 20%. And that's generally speaking higher than you're going to earn in the stock market. So I would tend to make an all-out effort to pay that thing down as soon as possible and ask yourself, do you really need to keep buying all that stuff? Because that's what's killing you. So, again, this live for today attitude, forget tomorrow, it's can be very, very detrimental to your financial well-being.
Yeah, I agree with you. Well, Frank, once again, I want to thank you for coming on to the show and tell them where can they find your book at?
You can find it at Amazon.com, of course, good old Jeff Bezos, etc. You can also buy it on BarnesandNoble.com. You can even go into Barnes & Noble and you can order the book, and have them ship it to you, et cetera, et cetera. So there are a number of places to buy the book. And, again, it's something that I spent over 3 years writing, and I think it can really help a lot of people in a lot of ways.
Okay. Well, Frank, thanks again for coming on to the show. Farewell, fans.
Thank you.
There you have it. You have all the information. You got access to the book. The Golden Playbook is going to help you get to where you need to be, get you in the right mindset so you can go ahead and start investing. Now, we're also going to put that link in the description so you won't have to write it down. Don't worry, I got you. We're going to go ahead and put it in the description so you'll be able to click on it and go straight there and go ahead and get the book. We will catch you on the next go around. We will catch you on the next interview. Peace.
Peace. MSG, thank you a million. Thanks a million, my